time for Lykken on Lending.
Welcome, everybody. Good to have you with us.
Welcome to Lykken on Lending, a weekly mortgage market update providing up-to-the-minute information on interest rates, loan programs, and hot industry news, all related to the mortgage industry. Brought to you by Transformational Mortgage Solutions. To participate in today's program, our guest call-in line is 646-716-4972. And now here's your host of Lykken on Lending, David Lykken.
Let's begin.
Welcome, everybody. It's Monday, May 6th, the day after Cinco de Mayo. So here's a little pop quiz for you guys. You ready for this? How do you come up with what does Cinco de Mayo mean? Cinco, 5, de Mayo, May. So it's the 5th of May. A lot of you know that. But anyway, also yesterday was May 5th was the beginning of Ramadan. So to all of our folks that are that particular religion, we just wish you well and all that. Unfortunately, 600 rockets were launched into Israel. So why is it Ramadan has to kick off all this kind of violence? But yeah, 600 rockets didn't make a lot of news, but that is also having a quiet impact on the markets. Can't wait to hear from Joe Farr later on. But it's good to have you here with us. Sorry for that downer note, but I wanted to get that out there because it just blows me away that this is not being reported on nearly as much as it needs to be. Anyway, we're here. So the markets are tanking today, so we'll get that update from our good buddy Joe here in just a minute. But again, we say this podcast is created by mortgage professionals. It is for mortgage professionals, and we're so grateful to have you as our listener. We've won awards, and it's always good. We appreciate them. But really where it comes is your listenership and you passing it on. And there's so many of you that tell me you're listening. It just blows me away. So we're grateful that we're a part of the way you get your information on what is happening in this ever-dynamic, ever-changing mortgage industry. Our commitment, again, is to bring you timely information in an audio format that you can listen to anytime, anywhere. Again, May 6th, so if you're listening on a downloaded basis, you know what it's about. Anyway, we're proud to be a part of the Industry Syndicate. Again, you can go industrysyndicate.com, check it out. See all the other podcasts. We're pleased to have this affiliation, proud to be a part of them. They call me the pioneer, which means you're an old man. Like, you pioneered this whole mortgage podcast thing. So as did Alice, Andy, Joe, and we're so grateful to be here with you, bringing you hot information. Alice in her segment, I think it was a number of weeks ago, maybe a month or more ago, talked about VantageScore, and we went out and connected with, I met Barrett at the recent TMC, the Mortgage Collaborative Winter Conference here in Austin, sat down with Barrett and said, Barrett, we've got to get this on the podcast. So we sat down late last week, recorded an interview with Barrett Burns, who's President and CEO of VantageScore. Really some interesting information. One little tidbit is, and I had to go back and have him repeat it, so see if I got this right. You guys fact checkers out there, but they're using the VantageScore, 10 million more millennials will be qualified to buy a mortgage loan. So we got to get behind this within the industry. We're here to hear more about it. Not getting a lot of traction yet, except a little bit of listening ears from our friend at Freddie Mac, and also we'll see with Mark Calabria now in at FHFA if we make any more progress. Before we get started, let's say a special thank you to our sponsors, the Mortgage Bankers Association of America and Black Knight. And today's competitive market, critical for lenders is the delivery of decision quality business intelligence, and it's getting it to the right employees at the right time to answer the demand. We have Black Knight. They've developed this actionable intelligence platform that delivers data that drives growth and reduces cost. To learn more about this intelligence, this powerful solution that can provide you an advantage, go to blackknightinc.com. Also, Open Mortgage, leading buyer of reverse mortgage loans and home of some of the top LOs in the country, as well as Finastra. Now, Finastra has their Fusion Mortgage Bot solution, automatically addresses compliance issues and a whole lot of other very neat enhancements that bring about borrower satisfaction and also greater market share. Great group of people. I tell you, I love their mobile app. That's one of the things that I'm looking at and seeing some great advantages. We did recently two webinars for them and got some great feedback on their mobile app. Check it out. Finastra. Then we can talk about Lenders One, the mortgage cooperative. These are both mortgage co-ops creating competitive advantages for both lenders and vendor members. Velma, an efficient mortgage marketing email platform. We use it to get the word out. If you're not signed up, be sure to contact us, as well as Knowledge Coop, providing easy and fun training for mortgage experts, and Vidyard. It's a video platform that we're using for our business, and we're recommending it for a lot of mortgage companies out there, and more people are listening to it. We're hearing from them say, hey, listen, I heard you talk about Vidyard on the podcast, Lykken, and we decided to give it a try, and it's really got some cool features. So if you're an underwriter sending out an email, you can just send out an email or add a little extra touch, a personal touch, record a video, go through the conditions, and send it out. Check it out, vidyard.com. And finally, a special thank you to Alice, Andy, Alan, and Joe for their contributions to this podcast each and every week. And we're going to take right off into the Hot Topics segment with Barrett Burns, who's the president and CEO of VantageScore. Folks, I'm excited to have Barrett Burns with us, president and CEO of VantageScore Solutions, LLC, located in Stamford, Connecticut. Barrett, good to have you here with me.
Thanks. Great to be here.
Well, you're a bit of a legend in the industry. You've been around. I've seen you for decades at conferences and a part of the leadership of the MBA, and you've led a number of real important initiatives, and I'm really excited about what you're doing now. So it's hard for me to imagine that our audience doesn't know who you are, but we do have a number of new people coming into the industry, and a lot of millennials, thankfully, coming into the industry, some new blood, much needed, and we're glad to have many of them as listeners. So for those that do not know who Barrett Burns is, would you share with us a little bit of your story of how you got into mortgage lending and your journey to where you're at today at VantageScore?
Well, thank you. I've been with big brands, had been with big brands all of my life, major consumer lending companies, Citicorp for 26 years, and Ford Motor Credit and Bank One before as part of Chase. So deeply involved in senior positions of large mainstream lenders, and also with a lot of brand management experience in those companies. So the way I got to this, I'd like to tell you that it was, brilliant career management, but actually it was by just dumb luck. I was having lunch with a scoring consultant that we'd used at Citi and Ford just to catch up with him one day in April of March of 2006. And he said, gee, have you noticed the announcement 2 days ago from the three credit bureaus? They've created a new scoring model. And I said, no, I actually hadn't seen that. And he said, well, let me tell you what it's all about. He said, it's brilliant. Wouldn't you know, I get back to the office that afternoon, and I pick up my phone. I always like to pick up my own phone. I pick up a phone, and the person on the other end was a headhunter from Spencer Stewart. And he said, so-and-so recommended I talk to you. And he said, have you ever heard about VantageScore? And I said, well, as a matter of fact, I have. And he said, well, what do you know about it? And I told him. So it was pure luck that I had lunch with that consultant that day. And what they were doing was calling to recruit somebody to start the company. And so I thought, wow, this is a great opportunity to create a national brand, because the three bureaus saw a market need to have a different scoring model in the marketplace. And so that's how I got to VantageScore.
Well, you have had a distinguished career. Citi was a great place. You were there for a long time, since 1967. So we won't do the math on that, but you've been in the industry longer than I have by a few years. So it's good to have another veteran still in the game, and I really mean that. But let's get into the vision and how VantageScore started. What is the genesis of VantageScore?
Well, it was market-driven. Large lenders, including us at Ford Motor Credit, were saying to the bureaus, the three major bureaus in the mid-2000s, saying, market conditions have changed dramatically. Consumer credit had ballooned in outstandings. Crazy mortgage products were coming into the marketplace, and credit card lenders in particular were saying to the bureaus, how come we can't find more scoreable people out there? We're stealing accounts from each other, but there's got to be more scoreable people. So the major lenders were saying to the bureaus, we're not sure that the current models in the marketplace were recognizing the changing use of credit and the ballooning use of it. So the three bureaus put three people in a room each for 6 months and said, don't come out of the room until you've got a more accurate model and it's more consistent across the three bureaus with the scoring is and scoring more people. So that's exactly what happened. And they tested that model against every other model that they knew of, and it outperformed both not only in scoring people, but in numbers of people, but in predictive performance. So they then decide, well, now we've got to have somebody create a company and would donate the intellectual property to that company because it has to be independent of the three. And so that's how it started. And so it gave us a chance, being new to the market, to create and test different architectural designs that could be, safe and sound, and also non-discriminatory to score more people and do it more accurately. So that being new in the marketplace gave us a chance to, create something different from the status quo.
Let's talk about score more people and score more accurately. Dive into that a bit.
Well, often people ask me, gee, will I get a better score from VantageScore? And our answer is, well, it depends on what you mean by better. The definition of better to us means more accurate, so that the consumer doesn't overborrow and the lender doesn't overlend. And the marketplace gets that once you explain it, I think. And also, it has to be stand up to all the fair lending regulations. The United States is pretty unique in having very clear, very crisp fair lending regs. And so our architecture was able to score more people. And the way we do that is we will score somebody who comes in new to the system in the first month of credit usage. So that picks up, let's say, immigrants or kids come out of school or divorcees or whatever, widows and so forth. And then we also look back, other models require 6 months of credit usage. So it's like, how can you use credit if you can't get a score on the front end in the first 6 months? And then we look back 24 months of performance, whereas other models look back 6 months. So if you haven't used credit in 6 months, you tend to lose a conventional model's score. And so then we tested that extensively, because having been a long-time lender, I would say, yeah, but you're going to give a score on 1 month of credit usage? Well, it turns out that's highly predictive. And so we've done tons of testing on it. And presumably all the 2,500 lenders that use us have done the same thing. And also looking back 24 months also is highly predictive. So we compare those additional scorables with the traditional scorables, and they have almost the same default rates. And so when lenders want to expand their portfolio without having to reduce pricing or credit standards, they tend to look at us so they can score more people to get them, into their applicant base. And so we sort of call it as, widening the box as opposed to lowering the bar.
That's good. And that's an important distinction. The fact that you're going 24 months versus 6 for those, especially this is applicable to millennials. And you have a lot of statistics on millennials. And millennials just are not heavy credit users. They're ones that will use it when necessary, but at least that's behavior patterns that I have been seeing and reading about. Would you agree with that statement?
Yeah, so let me give a little background to that. So when we started the company, several large Latino groups said to us, well, you score so many more people, there's got to be a high propensity of minorities in there. And we said we don't know, because we use credit file data, and that data is not in a credit file. And they kept pressing us hard on that. Well, sure enough, our latest model scores about 40 million more people than other models, and about 10 million of those are to 620 and above, and about 2.4 million of those are blacks and Hispanics. And the point was that particularly Latinos, culturally, as I learned from our Hispanic friends, are debt adverse. So they were being prudent, but being penalized because they could often not get a credit score. They're not frequent users of credit. So the point was recognizing people who borrow differently. Well, lo and behold, we're finding that's the same characteristic with the average millennial. And so we were getting kind of tired of the jokes about, the kids are still living in the parents' basement, and everybody would laugh about that. And we were getting a little tired of that, so we thought, well, okay, we're an analytics company. Let's go take a look at the math. So since we're on with the 3 bureaus, we have access to massive amounts of data. It's all anonymous data. We don't need or use addresses or names or social security numbers. But anyway, so we matched millennial data with income and assets data. And lo and behold, they're behaving like Latinos. In other words, they're infrequent credit users. And so they tend to have what the credit scoring industry calls as thin files. Thin files meaning less than 3 credit trades. And so that's what we call the infrequent credit user that often can't get a score because they haven't used enough credit. And so we're seeing where the millennials are having, those with the higher income and assets are highly correlated with thicker credit files. Highly correlated. And many lenders, for example, have some restrictions on thin files, or the applicants with thin files. So lenders are going to have to adjust to this because, and I'll come back to scoring in just a second, because we just saw some data where 45 million consumers will reach the typical age, this is millennials, will reach the age for first-time homeowners in the next 10 years, 45 million. And
wow.
They're all millennials. And so they're borrowing differently. So the industry, including credit scoring, has to take that into account. Now, that 45 million is 3.1 million more than in the 10 years prior. So there's this wave coming through. And of course, with Latinos, there's a wave of Latinos coming through. So I'm sure you see this from the research you see. So there's dramatically changing demographics and dramatically changing the type of applicant is coming through the system. But we're finding that millennials are becoming quite credit worthy, and that's based on the math. That's not on a survey. That's not on emotions. That's the math. And despite the student lending, which is a tough nut to crack, and I'm not discounting that, but those who aren't buried by student lending, they're looking pretty good. And very attractive, loan applicants.
When you look at the additional people that qualify for a mortgage loan, by widening the box without lowering the bar, how many more people can get a mortgage loan as a result of using VantageScore?
So we did a cutoff of 620 because, that's FHA cutoffs and so forth. Yep. So at a 620, we score roughly 10 million more people than conventional models. And of the 10 million, 2.4 million are either Latino or African American. Okay. So now that doesn't mean they're going to qualify for the debt to income and LTV and all that. But you probably know that Fannie and Freddie use a old FICO model.
They do.
For the first screening through the automated underwriting systems. And if you can't get through that first screen, chances of getting a mortgage are pretty low. Then you're pushed over to manual underwriting, which then pushes the pricing to the maximum pricing just because they can't get a credit score. So, and by the way, those old models were built on data from 1986 to 1996 to 2000. Right. So 20 years old basically. So those models are
and things have changed.
Outdated. Things have changed. So that's how the math works on scoring more people.
Well, when you look at some of the other characteristics of millennials that leap out at you, what are some of those?
Very conservative on acquiring debt. I suppose we could all probably speculate why. They and their parents came through an ugly recession. I think probably some fintech thinking. For example, a lot of them tend to like debit cards as opposed to credit cards. So, and that's not a debt instrument, a debit card, so it's not being picked up in a credit file. So I think this changing spending patterns has created that. But as we educate more people, I think they're realizing, well, they really should use the credit card prudently to build a credit history. But I suspect it's because, the recession scarred a lot of people. And if you've only been through one credit cycle in your life, that's a big one.
And that was the one with the ugliest ever.
Yeah. So I think it puts a little bit of religion into leverage.
Yeah, it does. Talk about some of the acceptance of the investors, the investor community. We talked about Fannie and Freddie a bit. Where are they at? Are you making progress in getting general acceptance, or are you early on that journey?
So it reminds me of in September. So in September of 2006 is when we went live with media and announcements and things like that. And I was on CNBC with that's when Liz Clayman was on CNBC at the time, and she was interviewing me early in the morning. And she threw me a question I had not thought about or not rehearsed. And she said, "Okay, what's success?" And I hadn't thought about that, frankly. And we were so busy setting the company up, I hadn't thought about that. So I turned to her and I said, well, success would be when we become a household name. We're not there yet. We're getting there. And so on the user side, last year we had about 10.5 billion scores used by 2,800 unique users, and 2,500 of those are financial institutions. So we're getting pretty good acceptance there, not in the mortgage space because of the restriction by FHFA, but on the credit card side, about 4.4 billion of those 10.5 billion were used by the credit card industry, and about 2 billion are used by free credit score websites, which we like because we tend to give them a lot of content to educate people how to manage their credit behavior to improve their scores. And that's another mission of ours, is education. So, and in the investor community, there are a number of securitizations that are used with us in there without any enhancement or penalty for the use of the score. So we're getting there.
You're getting there. It's on a journey. Talk a little bit about your architecture. How's this set up?
Well, to recognize the infrequent credit user and to prove to regulators and users that math works. And so the architecture is all designed around picking up the infrequent user, the user that has a thin credit history. So to that point, by the way, in our last model, we employed machine learning, not AI, but machine learning. Mm-hmm. And we came up with something like 50,000 attributes, meaning all the combinations and permutations of that data gave us a significant predictive lift in the thin file. And then at the higher end, meaning the lower risk consumers, we implemented trended data. And trended data goes back several years on how people have performed on their, for example, credit cards and auto loans. Did they switch behavior? Were they paying the full amount in each bill every month for years or whatever, and all of a sudden switch to the minimum payment? Or the other way around? Or did they move from using 50% of the line to 80%? Or the other way around? In other words, looking at the trends as opposed to a point in time. And that has given us significant lift on the high end. And you'd say, well, what did you need that for? Because if on the high end, and that was the high scores and the low risk, well, why would anybody bother getting that finite? Well, the reason is when lenders, auto lenders or credit card lenders or whatever, are pricing at the high end or giving different packages, offers, boy, they better be really fine-tuning their offer with a highly precise model. And so that's what trended data does, is to really give those lenders at the high end very specific predictive insights, because, their profit margins at the high end would be tiny. So they've got to get it right. And so that's some of the architecture that we're using.
Talk about the 2,500 lenders. How many of those are mortgage lenders?
0.
Okay, that's what we've got to change that. That's what you're working on. You're petitioning?
Well, we've been petitioning Fannie and Freddie and FHFA for quite a long time. And if you ask me why is it taking so long, the answer is I don't know. I've been thinking about that, working on that for 13 years. But we'll get there.
Yeah, you will.
Well, our point there is not to replace FICO with us. Our point there is to have FHFA validate both companies' models and offer choice to the lenders and let the lenders pick. It's about competition. And it's not about replacing one monopoly with another, but simply as the rest of the industry, the rest of the credit industry does, let us compete on a fair, level playing ground.
And you've got some wonderful resources on your website I'm looking at here. Talk about them and where people can learn more, and how can we get behind this? What gets my attention is 10 million more potential homeowners that may not otherwise be able to buy a home following the traditional models, the FICO model, could buy a home, and that's an opportunity for many lenders. And so we want to get behind this and see this work. So talk about your resources. How can people learn more about VantageScore and hopefully get behind you and champion what you're doing?
Well, thank you. So one of our missions, and in fact, so we're run by the 3 credit bureaus. We license the models to them. They sell the models into the financial community. So our mission is to develop and maintain, high-quality models, but it's also, and this is in our agreement with our written contract with the bureaus, is about education, credit education. So our websites are all about education. We don't sell anything on them. We don't track who comes on them. We don't want to know. We don't need to know. They're not going to get an email from us. But they're about education and how to legitimately improve your credit behavior. So what we've been doing is reversing the methodology. Most people would obsess about what the credit score is and then change their behavior. And we think that's the wrong way around. So we spend a lot of time at conferences on our websites, and so we're saying, here's how a credit scoring model works. You don't have to be a PhD in applied mathematics. Here is how it works. And if you do these things, and maintain this behavior, your credit score will improve. And then we have a couple of websites. One is called reasoncode.org. When an applicant gets turned down for an application and for credit, the lender by law has to return reason codes. Why did you not get the loan, or why did you not get the best pricing and terms and conditions? And those are called reason codes. Here are the 3 or 4 reasons. Most of those reason codes you can't understand, including ours when we began. And there were a couple of reasons for that. I don't want to be disparaging, but they were usually written by mathematical folks versus business folks. But also, the fields in the computer systems for the lenders are short, so there wasn't a lot of time to put, or a lot of space to put content in there. So we have a website called reasoncode.org, and you type in you enter the reason code number, and it'll come back to you with a lot of content. So here's what happened. Generically, because we don't go into their credit report. But say, if you've got this reason code, here is most likely why, and here's what you can do to improve your behavior there. And so my point is that it's all about opening up the box, the black box, supposedly, and teach people how this stuff works. So we have 2 types of websites. One is for lenders, which is VantageScore.com, for them to come in for content and our white papers and so forth. And then the consumer side is YourVantageScore.com. Then we also have a joint venture with the Consumer Federation of America, which is a quiz, and it's a very simple quiz written mostly for maybe a high school senior level or something like that. And it's a quiz to say, just ask people to say, well, for example, one question is, if you had a subprime auto loan for 60 months, how much more would you pay for over that 60 months in cumulative interest on a subprime loan versus if you had a prime loan? And so that website is called creditscorequiz.org. And again, we don't track who comes on it. We don't need to know. We don't sell anything on it. But Consumer Federation of America and we decided we needed to figure out a fun way for people to learn more about credit scoring and credit management. So those are some examples of our websites. And we do a lot of research. We publish a lot of white papers and things like that.
There's some excellent resources here, and I encourage lenders to get to your website, click the lender side, but also just go over and explore the consumer side. If you're looking at sharing information resources to consumers, what a great resource. And it's all out there, available, and so easy to download. I'm really behind what you're doing, and I want to do a better job of championing VantageScore into virtually the entire mortgage industry. And what is the best way, in your opinion? Barrett, you've been fighting this battle for a little while. What's the best way for us as an industry to get behind you to support you?
Well, thank you very much. I would say, conversations with the FHFA and Fannie and Freddie. Say, we'd like to have more access to mainstream credit, because we all know when you don't get a credit score, you're a sitting duck for predatory lenders. And so it's not only just for mortgage lending, but it's for lending in general, mainstream lending. But conversations with FHFA, with Fannie and Freddie would be quite helpful.
Well, hopefully we're going to get this podcast in front of the right people, and I'm going to be contacting several of the networks that I work with closely to get this information out and hopefully give you a greater platform to speak on to get the word out. But I've been on with Liz Claiborne numerous times. She's over at Fox now along with David Asman. They would do a program, and I've been on there with numerous times with them. So I'm going to get a hold of them and the producers and all of them over, see if we can't get this pushed out to a broader awareness. And I think you're doing a great work. How can people, again, learn more if they want to get into it? I know the website, VantageScore.com.
Yes, and a number of lenders, American Express, Chase, on and on and on, use us for their free credit scores. So that's another way they can go on those websites and see us too.
And if someone wants to reach you, Barrett, because they want you to speak or are going to want to talk to you about with one of the agencies, if we can get in at the top, what's the best way for them to reach you personally?
Sure. Just come into info@VantageScore.com.
Perfect. Barrett, thanks so much for taking time. It's been taken a little while to get you to be able to get our schedules coordinated where we could interview, but ever since we met at the TMC co-op meeting here recently in Austin, I was just passionate about getting this message out, and I'm very excited to have had the opportunity to do so. I'm looking forward to sharing this interview with all our listeners. And listeners, I encourage you to take this interview and share it with your lenders. Get out and let's get some weight behind this. That is assuming you want 10 million more potential buyers out there that you can finance homes for. If you're interested in that, then get behind this. I think it's a great idea. Barrett, again, thank you so much. Looking forward to having you back. Keep us posted on the progress you're making, would you please?
We will, David. Thank you so much. Appreciate it.
You're welcome. That was a great interview. Again, that was, Barrett Burns, who is the President and CEO of VantageScore. It's a great scoring model that I encourage us to get behind as an industry and push to see if we can't get this over the hump. A regular part of the way we pull credit or evaluate credit or do credit modeling. Anyway, next week, it's Mother's Day next Sunday. Don't forget about that. But in honor of Mother's Day, I am excited to be recording and playing next Monday an interview with Jason Frazier, who is one of the founders of the syndicate, the mortgage syndicate, which we're a part of. And we're going to be interviewing Jason as well as his mom, Marilyn Richardson, who is president and CEO of Mason McDuffie Mortgage. That's right. It is one of the top mortgage companies, 100 mortgage companies in the nation. It's been around since the beginning of the mortgages, I think since the beginning of paper, and it's a great company. I met Marilyn in San Ramon at the social survey event that they had and this last fall, and I tagged her and I said, we've got to do a combination interview with you and Jason, and that'd be great. So to honor all the moms out there, thank you for all that you do and appreciate it. And you mortgage moms, come on, let's get behind this podcast. Mason McDuffie Mortgage, Marilyn Richardson, President and CEO, will be on next week. You'll enjoy that interview and looking forward to having you all back here next week. Again, special thank you goes out to all of our sponsors, Black Knight, Open Mortgage, Finastra, the MBA, Lenders One, the Mortgage Collaborative, Velma, the Knowledge Coop, and Vidyard. Of course, special thank you goes out to Alice, Andy, Joe, and Alan. Have a great week, everybody. Talk to you soon.
You've been listening to Lykken on Lending, a weekly mortgage market update with your host, David Lykken of Transformational Mortgage Solutions. Join us next week, and thanks for listening.